Welcome all. Steve Parisi here with IBC Global. Hope your day is off to a great start as usual. So for today, during our podcast, we have a guest, a friend and a client that we've been working with for a while, MWelp. Mark, how are you today?
Steve, how you doing? Great to talk to you. Thanks for having me. Definitely appreciate it.
Likewise.
Thank you.
Likewise. Thanks so much for your time as well. Really appreciate it. I know you guys got a ton going on, but I think we'll have some fun today.
Yeah, definitely. Always here to
Definitely.
help. Definitely appreciate it.
Definitely. Well, thank you so much. So, Mark, a couple of things I wanted to talk to you about today, just about cash value life insurance, the banking concept, really your journey and experience with the policies. But to start, I think a little bit on your background and then how we connected would be valuable for a lot of listeners. Because when it comes to cash value life insurance, especially with the way that we'll design policies or if someone's interested in it for cash accumulation, some of it's technical stuff and requires, call it math or just sitting down saying, okay, how do I maximize the cash value? And when it comes to numbers, I mean, that's kind of your thing, right?
Yeah, yeah.
So your background, your profession, you're a CPA, you're a partner at a firm, correct? Hmm.
Yeah. So just a little background. I appreciate the introduction, Steve. I'm a CPA by trade, and just in terms of just where I'm at in life, might give a little bit of help in terms of I'm 40, so I hit the big 40 this year, and this great 2020 year. But it kind of gives you some guidelines of where I'm at and how I discovered first cash value, and then discovered you and your firm. Um, I've been a CPA for about 20 years, all in public practice, all working at a public accounting firm doing audit and tax work for clients. And during that time on the side, I always was your typical 401k IRA person, just putting money in the stock market, mutual funds, which is fine, no problem with that at all. That was me throughout my 20s and early 30s. And then I discovered cash by life insurance through going to invest in real estate first, right? So back in your 20s when I'm young, you're always looking at some of the financial entertainers about how whole life is bad, quote unquote. And you know, when I just discovered real estate, I discovered whole life and real estate are very similar, right? So you start diving into the world of real estate first in terms of going to buy some investment property, income producing property. You go in the real estate podcast first, listen to podcasts and learn about real estate. Now, some podcasts you hear about this whole thing called IBC,
Yeah.
infinite banking. So it's really through not being a CPA, but really through the world of real estate and buying some income property that I discovered whole life insurance basically is how it was, and kind of learned about that and tried to put that, the whole Dave Ramsey stuff, I'll put that to the side and really investigate what is this and how does it work basically.
Gotcha. So it was really so CPA by background, but real estate. I mean, that's the fun part. I mean,
Right.
yeah, how can you not like real estate? I'll always say with what you can do with it and such. I mean, you can. There's a lot of good whether you're flipping properties or you're just accumulating a portfolio for passive income. I mean, a ton of
Right.
value there.
Right.
But so that's what had exposed you to cash value life insurance. And had you been, let me ask this actually, had you been pitched on whole life insurance prior to that, just in the terms of a traditional old school whole life insurance policy, kind of what a Dave Ramsey or Susie Orman might, how they picture it or how they explain it, just basic, pay a premium, huge death benefit, horrible cash value in the beginning, takes forever to build up?
Yeah. No, I was never pitched that. I was just pitched on your normal buy term insurance
Gotcha.
and invest the difference, right? That's all I knew back in my 20s and 30s was just go buy term, invest the difference, and then pretty much the theme was what I was learned is don't buy a whole life at all, right?
Yeah,
Never buy that. Just buy term and put the rest in the stock market, and let it ride,
gotcha.
right? I never knew that much about whole life in general, and then really never knew about high cash value whole life. What you guys do,
Right.
if you structure it properly, you really start building the assets on your balance sheet. So
Right, right. A lot you can do with it. So,
yeah.
So when you were exposed then to cash value life insurance, so real estate first, looking at how to build that portfolio, and then the cash value life insurance side. So when you were first exposed to that, what were kind of your initial thoughts, and what had initially led you to us? Because I know we went into detail on the product, which we can get to, but cash value exposure, and then how'd you find us?
Yeah, yeah. So for the first question, really just cash value exposure, really through learning on my own. So I mean, when I first heard about it on a podcast, again through real estate, I really studied it on my own for a good 6 months to a year before I kind of reached out to people like yourself. Just really read books on it, discovered Nelson Nash, who that was, what he did and everything, and so really try to understand what it was and why are people saying it's so good? Because you hear about it, it's so bad, it's all fees, all commissions, no cash value to the 15th year. That's all you hear about. But then these real estate guys were saying, hey, if you want to buy real estate, you need to have liquidity. You need to park your cash somewhere, right? Um, so I went down that rabbit hole and really started investigating true IBC, true high cash value life insurance, and how it's an asset on your balance sheet. And now looking at 5 years later, my policies are really the best assets I have.
Yeah.
They're really better than my properties because they're guaranteed to go up, right?
Hmm.
Um, so they're when you really investigate, really learn about it, it's really the best place to store your cash and liquidity, right? Best place to put it, safe, guaranteed. So that led me to exploring. Okay, obviously I need to buy it from somebody. I need to go find an agent from somebody. Um, and with your firm, your company, I really got lucky early on in terms of getting it structurally proper in terms of high cash value life insurance. As you know, there's people out there and that I reached out to, but they really did not educate me first. And that's the big part is it's really educating somebody, the consumer, on what this is and how to use it. Whereas I think I would go online to someone's website, put in my age, date of birth, male or female, and then an hour later I get this big illustration,
Yeah.
and I'm like, what does that mean? I don't know what that means at all.
Yeah.
But when I found you, luckily on maybe my third or fourth try, early on, lucky, I found your firm, and we had just 3 or 5 calls
Yeah.
about what it is before even going down the whole illustration route. So that's where I liked, obviously yourself and your firm on really the education route for, hey, this is what it is. It's not magic. This is what it is. It's how it can help you and benefit you. But the whole educational piece on your side was great. So
Got, gotcha. Well, thank you. No, I appreciate that. I remember going through just the details with you, and you had a lot of good questions. I could tell you had kind of done your research, your homework at the time. This was a couple years ago, which is good. I mean, I'm the same way where I like to dig into any kind of product, whether it's a financial product or even a car. Like I want to know about it. Where do they sell for in other states and other dealerships? But I remember going through that, and a question I'll still ask people today, because you've got two sides of it in my opinion. You've got the whole idea of the banking concept, which really teaches one how to call it bank on yourself. Use a policy as a financing tool. Once a dollar passes through a policy, it's forever at work for you, regardless if you let it sit and grow or pull it out. And a lot of times people see that and you kind of got the wow moment. Oh, I didn't know you could do all this with a life insurance policy. And you can do it with real estate and a lot of other
right,
things too. But then where the question always comes up is, okay, like I understand conceptually how this can work, but tell me more about the cash value life insurance, because I hear really, really bad things out there, so things, and then really, really good things when you look at these big banks and corporations and the amount of money they put there. So I would, if I can recall correctly, the majority of our conversation was really around conversations, I should say, more so the structure of the policy, how to design it for high cash value, flexibility, right? We always bring up that phrase, hey, I want the ability to hit X, but I don't want to get a bill for X. I want to commit to an amount where I never feel like it's a burden. So when we had first connected, yeah, I do recall going through the cash value policy more so than the concept and how to design that policy. So I guess when it comes to policy structure, I know in your situation, without going through details, one of the things that I think, and correct me if I'm wrong, that I think attracted you quite a bit was the flexibility, correct?
Yeah, yeah. So when I first heard about this, I did not want my money locked up.
Yeah.
I think qualified plans have their place for certain people,
Hmm.
but after I discovered real estate and how illiquid it was, I didn't want to have money in real estate and in qualified plans, right? That's not me. So after I figured out, okay, whole life insurance is very liquid if you borrow against it properly, and then I figured out, hey, if I put money into it today, it'd be great to have all that money, have access to it tomorrow in 30 days, right? So,
Hmm.
like you said, the flexibility and the company selection are very important to me. And we had numerous conversations about, hey, Steve, so is this really just like a high yield savings or checking account? Because if it is, that'd be great. In which it is and still which it was and still is in terms of if you structure it properly with people like yourself, get the right companies where it's very flexible, where yes, I have to pay a base of this premium. That's required base premium. But if I have enough liquidity or cash flow, I can put in more up to this. Then that flexibility is key for me
Yeah.
because there's no guarantee I can put in this big amount next year. I don't know,
Right.
but I know I can manage this small base requirement.
Hmm.
So that flexibility was key for me. In
Gotcha.
terms of it's almost like a savings account. I could just transfer money from my checking at a bank, True Bank, to this mutual life insurance company,
Mhm.
take ACH withdrawals or loans right on a dashboard on a screen. These companies that we use that I use, they're not as tech savvy as a regular bank,
Yeah.
but they're pretty close, right? They're pretty close. So to make a policy loan request online, to put in money online, ACH from a checking account, that flexibility was key for me in terms of picking the agent and picking the company I was going to work with, basically. So
Right. Right. No, I recall that, and that was part of the discussion. Call it just the convenience factor when you look at different insurance carriers.
right, right,
Who's more convenient? And that, I mean, we could talk for hours just about policy flexibility alone. Yeah, in respect to if I take a life insurance policy, right? If I want the ability to put in, to use a round number, $10,000 per year, and I can set the base premium, say as low as 1,000. I can set it higher, but look at the numbers. If I set it at 1,000, some companies will require, hey, if you want to max it out at $10,000, that is all in one shot. If you
right,
want if you want to add funds at leisure, you've got to go through underwriting. It's kind of a pain. It's not convenient at all.
right, right,
Versus other carriers will say, okay, you can pay your minimum on your policy anniversary date when it is due. And then at your discretion, you can go on your online portal and just pop funds into PUAs, accelerating the cash value, the long term death benefit, all that good stuff at your discretion without any underwriting. So, and I remember going into details with some different carriers when we had first connected because that's important, especially if you want
right,
to use it. Yeah, and especially the way you're using it frequently to say, okay, when I've got the money in there, I don't want to be committed to this big bill. Give me the flexibility, and that's really how I maximize. I'll call it the cash value if I max fund, and then the flexibility, so I'm never tied to a bill. Maximize it first, and then step two, how do I use it?
right. Yeah,
Yeah.
that was key for me because, like you said, I don't want to go through underwriting for a PUA. I don't want to do that. I want to put a money at leisure, just like a savings account, and that's where like some of your clients are different in terms of. I think a lot of people focus on the dividend rate, which
Yeah.
is important, very very important, obviously.
Mhm.
But if it's 6.2 versus 5.4,
Yeah.
at the end of the day, on a long-term asset, does it really matter? So,
No.
so, so myself, I did not get hung up on the dividend rate at all. I went with the company and obviously agent team where I can be flexible with the policy, like you said, in terms of put the requirement in every year and then put money in as I can with the PUA.
Mhm.
Flexibility is key, just to make it just like a high yield savings account, and then
Yeah.
obviously use that money because for me and probably for most of your clients, the uh, the life insurance is probably one of my best assets on my balance sheet, but it's not an investment. It's
Right.
not. For me, it's not. So I want to put money in there, liquidity for savings to beat inflation, obviously, to provide death benefit for my family. When you have a wife and kid, you want death benefit just in case stuff happens, but to really use that money to go buy investments,
Right.
right? To really use that money to go buy a business, to go buy a piece of real estate or whatever it is. And that's why I like it for to park money places that it's safe, guaranteed. It's going to grow no matter what happens. Knock on wood, obviously, pretty
Yeah.
safe. And then go borrow against it, not sell it. Go borrow against it to go buy other assets,
Yeah.
which hopefully they should beat that dividend rate, basically, or
Yeah.
beat the policy loan rate as well. So
Correct, correct. Yeah, no, I mean, you can do so much good with it. And it resonates so much with real estate because, and I'm sure you can speak to this, a lot of real estate investors will do exactly what you just mentioned with property, only now you're shifting the liquidity over to a policy because of the guarantees goes nowhere but up and is extremely liquid. You don't got to go through underwriting and a bunch of questions to get a loan. You say, here's how much I want, and it shows up via direct deposit. Hmm.
yeah, yeah. So it's been great. So I mean, I've my oldest policy is probably 5 years old. So I'm getting into that, really accumulating the cash in those policies. And I think this probably sounds familiar too. When I first started, I was a little nervous. And like,
Yeah.
I think my first policy then was like $100. Like, does this really work? And everything.
Yeah.
Um, and I have numerous policies just because I started slow. I wanted to
Yeah.
learn everything.
Hmm.
Get a policy on me first, and get my second policy on me. Get some of my wife, some of my kids. Really try to build that legacy as well. So that's why it's a great tool, I think, for just storing cash, liquidity, building wealth. Leaving a legacy for your beneficiaries, obviously. And obviously, if you're using the IBC method, the true IBC method, using that cash to go do other things. So yeah, that flexibility is just key for me, obviously.
Yeah, fully agree. No, thanks for going into that. So one thing you mentioned that I actually want to go into a little bit as far as the dividend rate. When you first connected, well, when we first connected, I should say, how much value or how much value did you put on a company with the highest dividend rate prior to our conversation? Because that's often a huge selling point by insurance carriers. And a lot of times we'll show carriers that have the highest dividend or project the best rates, but we don't uh, move forward with them. Sometimes we do. We kind of show all the options to everyone. But prior to connecting versus what you know now, how much, if you can recall this, value did you put on, hey, should I go with that company because they've got the highest rate, or is there more to it? Did you kind of have that stance or just think they're the highest, they're the best?
Yeah, no, before I really talked with you guys and just do my own research,
Yeah.
I was looking at rates a lot, dividend
Mm.
rates, and there's people out there that will try to do this using universal life products, which quote unquote might have better returns, right? So before I talked with you, I was looking at that as well. Like, hey, I'm going to buy this universal life index product and get this return of 8% or whatever, and I'm so glad I didn't, obviously. But yes, I was looking at rates a lot because I was looking at it more as an investment for
Right.
me in terms of, I had this mutual fund. I'm getting this rate, so called. I'm going to park my cash here and get Universal Life Index and have it guaranteed and have a great return, which they don't really go hand in hand together, right?
Right.
So it wasn't until I really, read more, listened to more podcasts, talked with your team about, okay, I'm going to do strict, traditional whole life insurance, which has a lower dividend.
Correct.
But after I really learned about, hey, it's not an investment for me, or it's not an investment by the IRS or by MEC test or whatever. It's not an investment, it's just cash.
Hmm.
Then I didn't really care about the dividends. Obviously, I wanted to beat inflation, which it really will. It's tied to the interest rates, obviously. Um, but yeah, I was looking at Universal Life Index first, and just got focused on rates, and
Right.
it's really promoted, obviously. So that's how it was a little bit some time ago. So
Gotcha. Yeah, no, thanks for sharing that because that, I feel like the life insurance market, most people gear towards that just because it's common thought or mentality to say, hey, which one has the best rate? Which one's going to give me the most money? and it's all tax free. Yeah, but then at the same time, how I look at it is okay, well, with a cash value life insurance policy, and this is where I get very technical on my background because we would do this all the time before I was on the sales side and business owner side of things, was aside from the dividend rate, aside from projections and illustration, throw all that out the window. What companies and products have consistently delivered the strongest actual cash values, strongest IRR, just greatest growth on the cash value and death benefit to consumers? And then once we get that down, that's kind of my approach, is to say, okay, teach everyone how to max it out first from a cash accumulation and flexibility standpoint. Because if you've got the best performing, call it asset, then whatever we do with it, whether we just let it sit and accumulate, or if we decide to use it to acquire real estate or whatever it might be, we're going to have the most money to do so. So let's set that up and attack it. But the actual performance is huge, because I see this a lot. I see it with a company that I don't use at all because I can't. They've got kind of a captive setup. Northwestern Mutual, behemoth of a life insurance company, has had a strong track record forever. Now, with them, if you look at them today with their 5% dividend rate, among the lowest in the industry, they do not project pretty values at all. And a lot of people go after them and say, oh, they stink. They're not what they used to be. I'm like, okay, even though we can't use them, if someone has a policy in force and it's set up right with them, like, they're going to perform. They always have, based off of their actual data, not their projections. So that's kind of what we look at with all carriers, the ones we use in addition to Northwestern. If someone showed me a Northwestern policy, I'm going to say keep it. But
Yeah.
that's another note.
No, that education is key, and it's not easy to learn all this stuff because it's not marketed, you know.
Yeah.
Like, I mean, whether you use a big company or a small company, I mean, you don't watch TV and see a commercial for this mutual insurance company. Maybe some, obviously Northwestern, you see them, but you don't see a lot of them out there on
Yeah.
TV advertising, where you'll see Fidelity all day long, right?
Hmm.
So the education process is huge. And then, I spent so much time, Steve, looking at the whole direct versus non-direct product, which you can go down a rabbit hole and just, look at numbers all day long and then never make a decision, right?
Yeah.
And obviously it's important, obviously, but now looking 5 years later, it's really not that important, because if you have direct recognition policies like some of your companies go with, there's ways to still um, have that grow properly and everything. Or even in today's environment, you could take that policy to a bank or a
Yeah.
lender and get the loans off the books of the insurance company, and have that dividend rate not be affected at all by policy loans if you wanted
Right.
to. So
Yeah.
all this stuff you learn about kind of after the fact, but you spend so much time up front trying to learn that as a consumer.
Yeah.
And if you're not with somebody, an agent who's really educating the person, if they're just throwing stuff in front of you and saying buy this, buy that, it's easy to get caught up in all stuff because there's so much to it. But at the end of the day, you take a step back, like, it's really just a nice cash equivalent to park your cash, and all those details, they matter, but not too much, because if you're paying premiums on an annual basis, on a regular basis, it's a great way to save money, which is key.
Yeah.
Just like a 401k account, but it's guaranteed to grow, and you can use that money no matter if you're 30 years old or 80 years old. There's really no restrictions.
Yeah.
That's the big thing I heart to people, is that, hey, if you get policies younger and you get that death benefit in place and you just pump money in there as much as you can, it's still there to use wherever you want to do,
Yeah.
cars, vacation, investments, whatever, college. Um, so obviously you read about it, learn about it, let Steve's teams, handle the details and everything, all the details, but just go buy it. Go buy
Yeah.
it, right?
Yeah.
That's all there is to it.
I hear you. Yeah, as far as starting, just you got to start somewhere, and it's always it's hard to do in the very beginning if we're brand new to it. I'm like that, and my business coach has helped me. He's like, dude, I remember the first time I met with him. He's like, I had a half an hour call with him, and at the end of the call, he's like, I know your problem. You got to make decisions faster, bro. And he's I'm like, all right. He's like, so here's an exercise. You and your wife, you gotta be on board to do this for the rest of this month. when a decision comes up, just say we're either going to do it or not. I'm like, all right. I mean, in reality, I'm going to struggle with that. He goes, I know, but you got to do it.
Yeah,
Like,
yeah,
yeah. But since then, and I try and apply that with every decision making process now, unless I need to get the analytics and get enough information. If it's something I don't know about, going to get the information as quickly as possible and then make an informed decision. But it does help with the decision making as far as, okay, does it work? Has it been successful in the past for others? If yes, all right, let's just do it.
yeah. Yeah, I mean, in these companies, no matter if you have a big company or a small company, these companies have been around since 1890,
Yeah.
1895, on the whole life traditional product, obviously. So if you stick to that, you can't go wrong. And as you know, you can have that analysis paralysis thing. Just like in real estate, you might look at over 100 properties, and you just can't buy one because it's
Yeah.
not perfect. Same with this, you might look at every carrier, every agent, or look at every dividend rate, you still might not buy the policy or start underwriting. Which it's so weird, Steve, because you have that, which is it's a guaranteed product. There's people out there who will just pump money in the stock market and over 2,000 mutual funds. They have no idea what's in those mutual funds, right?
Right.
But this is a guaranteed product to grow. You really can't go wrong. It's just not that common. That's not the herd, right? It's not the herd.
Mhm.
So people kind of shy away from it a little bit. So
Correct. And I mean, it is called life insurance, which naturally, the instant you have that name life insurance, it's only normal for someone to think, all right, it's a life insurance policy. I pay a premium and the benefits, like I die and money gets paid out. I don't care about that. Maybe I'm a single guy or girl, like I'm not interested in it. Like, okay, that is true. It's the life insurance. That's the primary purpose of it, especially from the insurance carrier's perspective. But with that said, when you really look at the cash value, what you can do with it. Oh, and by the way, when you look at the uber wealthy, big banks and corporations, what's interesting, they pile all this money there. They have a long-term goal with the death benefit, but it's the cash value. That's their driver. Quick side story.
yeah.
When COVID hit, it wasn't COVID that caused this, but the interest rate downturn, things just started going down faster and faster. Um, and an executive at a bank actually shoots me a text that we work with. He goes, we've got a big pile of money that we need to move ASAP because they knew what was going on. They have their relationships and such. And guess where they put it? Cash value insurance. Yeah.
Bully, right? But bully or Coley, yep.
Yeah, that's exactly what they did. And it shows they just had a pile of cash they wanted to move over. They said, yeah, we can put it on whatever executives are most efficient. That will likely get more down the road, but we want to start in the most efficient area. And it was an asset in their balance sheet as a corporation. The death benefit has an absolute value for them and their employees in the way they set it up. But again, the cash value, that was their main driver and why they initially moved forward on that product.
Yeah.
Yeah.
Yeah,
Hmm.
it's just a product that could be used for anything, and
Yeah.
I think there's so much stuff out there on the IBC stuff, which is good, some bad. But I think some people really harp on that you have to use it. Like you have to put money in a policy today, and then pay all your debts to third parties tomorrow. You gotta get rid of it, right? And I think there's two different schools of thought that it's not right or wrong.
Right.
Um, but if you have low interest rate, 30-year mortgage, debt on properties or whatever, keep that in place,
Hmm.
and just pile up cash in your policy. To me, there's nothing wrong with just put a bunch of cash in a policy and let it grow and sit there for a rainy day or for an opportunity. There's nothing wrong with that. Rather than, I think some perspective is you got to take all that money in your policy, take policy loans, and pay out that third party debt as fast as you can. It's just different schools of thought, and there's no right or wrong way to do it. It's just different
Yeah.
schools of thought.
I'm 100% with you because we work with individuals on in both boats. What you just mentioned, both sides. I want to get rid of my third party that debt immediately versus some saying, okay, from a financial perspective, if I can lock in a mortgage at 2.75 or 3% and pile up money elsewhere, I can pay off the debt anytime I want. But I like having that cash asset there instead. Like my big thing from a business perspective is, hey, just like you said, there's no right or wrong. I mean, to take an approach and say this way is the way to go, everything else stinks. It's like, no, people are going to run away from me if I do that. Um, show both and just show the pros and cons to everything. Just like if you could see it on Amazon exactly how it worked, right? If you could sell this in the same manner Amazon sells everything else, it'd be so easy for us to buy it, that is, and make a decision. But you've got the education, and then you've got bias opinions and all that stuff out there. So it's like, okay, how do I get the information and make an informed decision so I can maximize my value?
Yeah.
Yeah,
Yeah, and I've gone down both sides, Steve. I think I've talked to you about,
yeah,
hey, I'm gonna pile up cash first and use banks. And I had a phenomenon. No, I'm gonna take some policy loans and pay off some of these 30-year long interest rate debts. And
yeah.
I paid off one property in the spring that had a long 30-year mortgage on it at like 4%. And I felt good about it for like one day, right? Then wait, now I have all the equity in a house.
Yeah.
Whereas for me, do you want to have equity for me in houses or equity in policies?
Hmm.
Now I changed my mindset. I want to have equity in policies,
Yeah.
right? That's where my equity is sit. And as long as it's, for me, good 30 or 20 or 30-year interest rate debt on assets. Now if it's credit cards or whatever, that's a different story. That's maybe get those out. But if it's long interest rate debt from a bank, I'm gonna let them fund it. I'm gonna stash up the money in my policies where it's safe and guaranteed.
Gotcha. Yeah.
So I think those two different perspectives are all over the internet. Obviously, not right or wrong, but after you start getting cash in your policies, it does make you sleep better. That hey, I have also equity in a product and a policy that I own. I'm a policy owner. I have really good control over it, and that makes you feel a little better on that, as opposed
Gotcha.
to just paying off all this, quote unquote, good debt.
Yeah.
Stash money in the policy and go buy some more assets, or go buy a business or whatever you need.
Yeah.
So
Absolutely. Absolutely. Well, let's transition a little bit because that's a nice bridge in. So we talked a lot about cash value accumulation, building the policies up, but using it is is key. I mean, you can do a lot if you use it properly. Now, obviously, you've got your company, right, that you run as a CPA, but on the side, I mean, you're big into real estate, correct?
yeah, yeah. So just the past 6 7 years, I've tried to develop some true passive cash flow streams, and discover hard assets to be a good solution for me.
Yeah.
I just like the regular single family house to rent out to a good tenant, manage it properly. And that's what I do mostly now, is just try to store my liquidity in policies and then try to go buy some assets for some passive
Nice.
cash flow. You
Gotcha.
know,
Hmm.
so I like to use the policy on kind of the down payment side.
Yep.
And you hear about that, and says, if it's a 100K property, go get a bank loan for 80,000. Use a policy loan for the other 20,000,
Yep.
and for example, you're all in for none of your own money per
Yeah.
se.
Yeah.
Um, but I like that approach a lot, where I'm using my policy loan for the down payment, and then using the bank debt at a good long interest rate, long amortization for the other
Hmm.
part of it, and hopefully using that cash flow it spits off to pay back that policy loan.
Yeah. Very nice.
I really like that approach, just to help build some assets on your balance sheet and provide some passive cash flow.
Gotcha. Very nice. So since you've been doing that, has it worked pretty well where you've been able to still accumulate real estate at a fast pace and service your policies? Because I know you've got a number of policies, as you mentioned before.
Yeah,
Um,
yeah,
yeah, on you and your family, and do you use all of them more or less because you're the owner. You've got control of
right.
them.
Most of them,
Yeah,
yeah.
yeah, most of them, that is, as a source to finance that real estate. But has that strategy worked well? So primarily, you're using the policies to fund the down payment and then finance the rest through the lender.
Yep, yep.
Gotcha.
Yeah, and
Okay.
and I've gone through all different sorts of approaches, Steve, in the past 5 years, in terms of you know using the policy to buy a car,
Yeah.
to buy assets, and I've done it all, and I've really come to a point where, since, I mean, the policy loan is debt. It is debt you got to pay back. Now it's a very unstructured policy loan, which is great. You pay back whenever you want to, but it's
Hmm.
still debt, and it still decreases your net cash in your balance sheet.
Correct.
Um, so now I've finally learned to myself that I like to use policy loans to buy assets that produce cash flow to pay it
Very
back.
nice. Yeah.
I mean, I've still used it to buy a car per se,
Fun. Yeah.
um,
Yeah.
but it's but also you gotta look at car loan rates are so cheap these days. It's like
Yeah.
it's just go get a loan from a credit union or whatever. But I like it to go by assets that produce cash flow so I can pay back that policy loan.
Gotcha.
That's kind of what I like to do.
Yeah, and that's the best move in my opinion if you're using it for that reason. But yeah, use it for fun too, like to finance a vehicle. Nothing wrong with that. Yeah, it's got a place there, and freedom and flexibility. Pay it back how you want when you want. But thanks for going into a little bit with the real estate there. I
Yeah.
know people are always interested in those strategies to hear from people that are doing it.
Yeah, and it can be, as you know, a business, anything, any
Yeah,
asset you want to buy. I just really look at it as, like I said before, they're probably the best assets I own, my policies,
yeah,
but they're not investments. That makes sense. Like they're assets, but not investments, right?
100%. Yeah.
So I could and I could just build up policies and never use them, and that's a great strategy too.
Hmm.
But for me personally, I want to develop some passive income streams. So to go use the policy, borrow against, not withdraw it, borrow against it to go buy the assets. That's key for me. And
Yeah.
when I learned that process early on, and that it still grows whether you have a policy loan against it or not, that's the key.
Hmm. Yeah, 100%. Yeah, on that point, because you mentioned that a couple times that this is your best asset. I remember in my earlier years, I was probably I don't know 3 or 4 years in the industry because I got in 2011. I started my own company in 2015, but prior to then, yeah, a couple different roles. But really, where I learned the ins and outs was of policy design and historical performance was modeling policies for the big players, corporations, learning from called the 1%, exactly what they do, specifically with cash value insurance. And I'm a nerd. I had a lot of fun with it. Um, but I remember a story. There's a construction company that I did not meet with the owner, but I was privileged to help model the policies that they actually went with. It was an executive benefit plan. All of their executives, they had placed these policies on. And the owner, well, his son owned it at this point in time, but he still ran it. He was older. He disclosed his policies to us, and we ran historical performance and analysis on them. He had, I think it was 6 policies plus. He had a handful of them, and he made a comment. This is a guy that had policies that had been on the books for over 30 years. He goes, I've got stocks, bonds, other investments, and aside from the ownership in my company, my best performing asset has been my life insurance policies because now I make a payment and say it's a $12,000 payment. I see a dividend come back and the cash value grow by 40 grand that year. And it's just compounding. He doesn't have to think about it, regardless of the ups and downs in the market. It just keeps on going up. And those were old school policies. When he had actually issued, when those were set up, they were just 100% base premium or something like that because they were 30 years ago, just a basic policy. But 30 years old, they're performing. And when you look at them, like, okay, wow, they're set up with quality carriers. You see the actual internal rates of return. They're doing what they're supposed to. But
Yeah.
yeah, it reminded
No,
me of
I
that.
I
Hmm.
I totally agree, Steve. I mean, just especially after you build them up, after you get multiple policies,
Yep.
yeah, like, they're hard to compare against other assets or because they're not investments.
Correct.
But I mean, after you build them up, yeah, they're the best assets in terms of they're guaranteed to grow. I mean, compared
Yeah.
to real estate, I don't worry about repairs or late tenants or late
Yeah.
payments or whatever. But I think it's important if you can build up policies and build assets, whether it's a business or whether it's a real estate, just to have those two different types of assets is great.
Yeah.
Or like I said, there's nothing wrong with building up policies and just using it for your whole life. There's nothing wrong with that either.
Yeah.
Um, yeah, it's just a great asset to have. And for me now, I have multiple policies. I'm kind of almost maxed out pretty much on I guess
Right.
myself and my family. I mentally I know that I need to go find more policies. Like
Yeah.
I need to go find more lives, right? That's what I need to
Hmm.
do.
Yeah.
It's harder now, but so mentally it's not that I'm done. Mentally it's more of like I need to go find more policies. And
Yeah.
that might be next year or might not be for 10 years. It just depends, right? Just
Hmm.
depends.
Sure. No, I got you, but you've got the right mindset there. So one last thing I want to touch on, and this has to do with your background as a CPA, because so frequently individuals we work with say, "Hey, I want to use my policy for real estate. I want to use my policy for my business to clear some debt. I've got this unique situation. Can I do anything creative? And aside from the life insurance, I want to find the best tax strategy." And they'll ask me that. I'm like, well, I can't really help you. Aside from sharing some of my experience and my work with individuals I work with, I can't help you because I'm not a CPA or a tax attorney. So the question they get is, okay, like my CPA doesn't really understand cash value life insurance. They just hear the word whole life and they say, don't put your money there. And I feel like I'm fighting with them on that point alone. So I know we've referred a couple people to you.
Yeah.
But that is an area where you, and I think your firm too, can help a little bit as far as, yeah, consulting and helping people with any tax situation. But really, the value there is you get it in terms of cash value life insurance, what someone's trying to do, as opposed to, hey, this is a whole life policy with a death benefit. It's like, no, no, here's my cash value policy. Here are my goals. What can I do in my overall situation from a tax standpoint? And how can this complement everything that's going on?
Yeah, that's a great point, and the tax benefits of these policies are great. And yes, I'm a CPA. I'm not giving tax advice on the podcast right now. Just disclaimer. But in terms of just having your CPA or professional know about it is key. And unfortunately, I'm gonna, I guess, make a comment on my profession and what they don't, right? Because
Yeah,
I think having a tax compliance person and a tax long-term planner is different, right? Your basic tax compliance person is so focused on getting your current year taxable income low
right.
to pay current year taxes lower, right? They're not focusing on 10, 20 years. So they go after the 401k, go after the IRA or whatever, right? To get
Yeah,
that current year deduction. Well, yeah, unfortunately, whole life insurance, it's like it's a mega Roth IRA.
yeah,
It's after tax dollars going to the policy. So, but once it's in the policy, if you do it right, it's tax free, tax deferred forever,
right.
right? The only thing you have to worry about ever is the estate tax. The income taxes, you should be fine, right? And I
Hmm.
think so many CPAs miss that point in terms of we're focused on, you know, 12/31, 2020, and that's it. We're not
Yeah.
looking at 5 years down the road. But
Hmm.
as a tax person, for me personally and our clients, I always say to myself the old adage, you want to pay tax on the seed or the harvest,
Yeah.
right? I'd rather pay the tax now in this low tax environment after tax and then put it into a place, if structured properly, we can defer the taxes forever, the
Hmm.
increase. And that harvest at the end of the day,
Yeah.
in 20, 30 years, should not be taxable at all, right?
Yeah.
And I always tell people too that you refer that I talk to about whole life insurance. If I had a client that had whole life policies, it actually makes your job as a CPA a lot easier because if you borrow against it, like you're taught, if you borrow against it, nothing goes on your return,
Yeah.
right? I mean,
Private.
it's just like when you go borrow for a house or a mortgage, you don't put that loan as income
Yeah.
because loans are not income, right?
Right. Hmm.
It's debt. So
Hmm.
if you had a client with a bunch of policies, it actually makes your tax situation a lot easier.
Yeah.
They just a lot of people just don't understand how it works and everything. They all freaked out. Where's it go? I'm like, if you take a loan, it doesn't go anywhere. Now, if you
Hmm.
take withdrawals and all stuff, you got to look at your basis and cost base and all stuff. But if you do the IBC method properly, you put money in after tax, borrow against it.
Yeah.
The whole thing of buy assets, borrow, die, buy, borrow, die, right?
Yeah.
It really doesn't go anywhere in 1040 personally,
Right.
So I think a lot of CPAs, unfortunately, in my profession, they're just they just don't think that way. They think about the current year and that's it, and not looking at
Mhm.
the long term effect of it.
Gotcha. Gotcha. Yeah. Laser focus in a certain area, which, yeah, I mean, everybody's got a niche, in my opinion. Yeah. Now, yeah, interesting that you mentioned that. And I remember there's a group that I like a lot down in Florida that has to do with the cash value collateral loans, kind of what you had touched on. Yeah, where you can take a policy to a lender and assign partially or fully your cash value to a lender to obtain a loan, just like a line of credit. You could do it with a lot of banks that offer it, typically at a very favorable interest rate. And the group you had introduced me to, I've talked to them several times. I like them because they're big on, yeah, no, thanks so much for the intro. I like them because they're big on convenience, but what I really like is the creativity there, where they've got attorneys on staff and such that if I own a policy personally, how they'll actually set it up is if you are obtaining a loan from them and you're using your policy as collateral, if it's for a legitimate business purpose, they'll actually write the loan where it's a business loan. Now, all of a sudden, how I look at it, I can sit back and say, all right, well, I mean, that's sweet because your policy keeps doing exactly what it's doing. But now you've got this potential tax deduction here too on the loan from the leverage. It's like a win-win. Like, how can you go wrong with
Yeah.
that? Yeah,
Yeah. And that's a question too. Can I deduct the interest and all that stuff? And that's a that's a
yeah,
fine line. I'm not going to get into too much, but as you know, I mean, just just regular policy loan interest you
yeah,
cannot deduct.
correct.
But if you go and assign it to a third party bank or lender for a business, and if they actually send you at the end of the year a true statement for your business, it's a business deduction, no
Correct.
problem at all. So
Hmm.
yeah, I get questions all the time, like if you want to use policy loans and for a business, it's probably better to go to this third party, get a
Hmm.
true business loan, assign the collateral, and then just be safe from a whole, just be safe that way,
It's clean.
So
It's much
yeah,
cleaner, right? I mean,
yeah,
I've heard of individuals, and they'll ask me all the time, "Hey, can I deduct just the basic policy loan interest if I'm using it for a business?" And my thing there is because the IRS, I know just from life insurance history, they don't like that. I mean, life insurance loan interest is not deductible. But then you talk to some, well, if you're using it for a pure business purpose, then maybe you've got that. I'm like, okay, that's great and all. But I never, ever want to receive those letters from the IRS that we all love getting in the mail. I got one, it was an accident. I don't know how they messed up my social security number. It's for for someone had the same name as me. I'm like, what is this? I don't own these mutual funds and such. This huge tax bill. I'm like, this is a mistake, man. But that was a letter. I'm glad it was a mistake. But I don't want to get those letters. And I feel like if you tread that water and it happens, now you got to do all this extra work. It's going to cost you or the CPA you're working with to try and fix the problem, as opposed to doing what you mentioned, third party lender, keep it clean because it's all documented properly.
yeah,
Yeah.
yeah. I think you just gotta be careful with that and how you use it. And I think some people get caught in the details of, well, if I can't deduct the interest, my policy loan is this still good? I'm like, if you look at the big picture, it's still one of the best assets you can have,
Yeah.
just a multiple thing. And
Yeah.
using policy loans or taking it to a third party bank, a third party person for collateral, that's all good stuff that you cannot do with qualified plan. You can't take a qualified plan and go to a bank and
Yeah.
get a loan against it. It's not going to happen. So,
Be nice.
yeah, it'd be
Yeah.
great. But
Yeah.
so it's just like a nice Swiss Army knife of a tool to use for so many purposes,
Yeah.
which works out great, obviously. So,
Yeah. Yeah. No, fully agree. Well, I think we covered just about everything we wanted to cover there.
okay.
Yeah. No, really appreciate your time. Again, well, let me just ask anything else that you wanted to touch on before I abruptly end and be a fool like I sometimes am.
No, I say people need to research it, learn about it. Don't have that stigma like myself where you hear your whole life and you just run away. I think
Yeah.
if you learn about it and you get a policy structure properly, it's 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 the best place to store your cash. You need to have reserves. You have operating cash account. I keep a lot of my liquidity in these policies
Yeah.
rather than a bank. You know, um, and I think getting started is the key. Go through underwriting, get a policy, pay a premium, get it going, and yeah, I think down the road you'll be happy that you did. So
Gotcha.
I appreciate your team and what you've done, and your education is key. So that's key for the clients, obviously. So thank you very much. Appreciate it.
Gotcha. Yeah, no, thank you so much. Appreciate that, the kind words as well. Yeah, well, no, thank you so much for your time. If anyone, yeah, if anyone listening wants to reach out to Mark or his firm, we've got his contact info in the description below. Yeah, whether it's for basic tax advice and such as a CPA, and or talking about cash value life insurance and how to use that. Because side note, you're life insurance licensed as well, right?
Yeah,
You are.
I'm a little odd. I'm a little odd fellow, Steve, as you know. So
Me too. Yeah.
I like to go run 10 miles when I can, and No, I'm a CPA, and
Yeah,
I really like how to learn what you know and to learn
yeah,
more about it. So I have my real estate license in Ohio as
yeah.
well to go buy some real estate. So is my wife, and but I got my life insurance license just to keep learning,
Correct.
and not really using it per se. I'm a full-time CPA, but just
Yeah.
to, if I come across somebody and I can talk a lot about it,
Legally too. Yeah,
yeah, legally,
that's the thing.
and maybe have it later on in life too to do other stuff.
Yeah. Hmm.
It's funny, as you know, they don't talk too much about high cash value IBC,
No,
obviously,
not.
which they should. Um, but it's good to have. I think it's good to connect different people, and yeah, maybe
Hmm.
down the road I can use it more and everything. But yeah, I
Yeah.
got it a couple years ago. So
Gotcha. Yeah, no, I recall that. And it gives you a nice edge too as a CPA where you can actually legally discuss the life insurance product without having to, yeah, worry about saying anything that we're not supposed to. But
yeah, yeah,
yeah,
yeah, you got
yeah,
it, you got it.
right on. Well, thanks again. Really, really appreciate your time, Mark, and I appreciate everyone listening. And we'll talk to you soon.
Great, thanks, Steve. See
All
ya.
right.
Bye
Thanks,
bye.
Mark. Bye. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.